to Phillip Securities Experts Talk. My name is Lindsay, and today we are privileged to have Mr. Christopher Adams, Director and Senior Product Specialist, Asian Equities from HSBC Global Asset Management, to take us through the investment outlook of Asian equities for 2013. Mr. Adams has been working in the industry since 2000, specializing in Asian equities since 2006. Prior to joining HSBC in 2011, Mr. Adams worked as the Product Specialist for Asian Equities at BlackRock. He holds a dual Bachelor of Arts, Bachelor of Economics degree from the Australian National University and is a CFA charter holder. Thank you, Mr. Adams, for taking time to attend this interview with us.
My pleasure.
With the note of gradual recovery based on various indicators and the greenback turning to its safe haven, how do you see Asia, which was previously flooded with hot money, position itself in the growth platform when US starts to taper its QE?
It's a really interesting question. We're seeing quite a bit of a divergence in views in the market at the moment, in as much as the news that we're getting from the US is ostensibly good news, that we're seeing a recovery in the world's biggest economy, that things are gradually getting better. Yet, of course, the reaction to this in Asian markets hasn't been great. And it's for the reasons that you mentioned, is that there is the perception that Asian equities have benefited from this inflow as a result of ultra-loose American monetary policy. And that has been the case to an extent. But I think there's a few things to say about this move. Firstly is that there is a little bit of concern that an outflow of US dollars from the region could have significant negative impact on the region in the same way that we've seen in the past. And certainly, while there could be some volatility associated with that, the picture today is very different from how it's been in the past, in as much as these days you've got floating currencies within Asia, levels of debt aren't as high, and a lot of countries in the region actually run current account surpluses. That hasn't been the case in the past. So actually there's a lot of cushioning there to counteract the effects of money flowing out of Asia. So we think that going forward, actually over the longer term, what's happening in the US can be quite beneficial for this region. Obviously a pickup in demand from the US is going to have long-term good effects for Asia, which builds and creates, manufactures a lot of the goods and items that are demanded in the US.
I see. Then, since, like what you have explained earlier, Asia's largest economy is undergoing a financial reform, albeit uncertainties in the global economics remain intact. The liquidity crunch backfired, sending HSBC flash manufacturing PMI to an 11th month low at 47.7 in July, further into contraction region as compared to 48.2 in June. Against this background, although Premier Li Keqiang vowed to maintain China's economic growth at above 7%, do you think Greater China equities will be a drag on the performance of regional equities moving forward?
I think it's been really, really interesting in that if we look at the markets over the last couple of months, when the market fell substantially in June, it was Chinese equities that led it down. When the market rebounded a bit in July, it was Chinese equities that led it up. So there's obviously a lot of concern regionally around what's happening in China, and there's no doubt that the movement of the Chinese equity market will have a significant effect on what's going on in the region. But I think it's worth bearing a few things in mind, and that, I mean, for all the concerns about the possibility of a hard landing in China, which really is what's driving a lot of this, that the government is trying to balance off reform versus maintaining a certain level of growth, and there's differences of opinion of whether or not that's actually possible. What we do need to bear in mind is that ultimately this is actually quite good news for the market. What would be more concerning is if the Chinese authorities were blithely just pouring money back into the market, or pouring money back into the economy in the way that they did in 2008. The fact that they're actually trying to address some of the structural issues in the Chinese economy is a long-term positive. So we think that, you know, from over the near term, so over the rest of this year, we could be in sort of range-bound markets for the region, and that, you know, Chinese equities will have a significant effect within that period, but long term, we're actually more positive on what's happening with Chinese equities.
Okay. Then based on Bloomberg, Chinese stocks are the worst performance, losing SGD 952 billion in value since its high in 2009. In your view, any key drivers for investors to remain positive towards Chinese equity markets in near future?
Yeah, if we went back to 2009, obviously, even prior to the mid-2000s, Chinese equities were a very popular story for international investors. And as a result of that, we saw Chinese valuations get to some fairly stretched levels within a regional context. They were reasonably expensive. We fast forward to today, and that's not the case. Where we look at Chinese equities today, the way we look at the world is we look at sectors and countries, and more specifically at stocks in the context of their valuation as compared to the profitability that they can provide. If we look at it on that basis, China's actually a really attractive market at the moment. It's one of the cheapest markets in the region, and it's got a good level of profitability. So that is a positive, that we're actually coming from a very low base. And then there are other incremental positives. As I said, longer term, the fact that the Chinese government is attempting to reform the economy, and that's something that has to happen if China is to avoid the middle income trap. So that's very positive. And we're just seeing, the government is balancing off this desire for reform against the desire to keep a certain level of growth, and we're seeing that in incremental policy decisions that they're making. So over the last few weeks we've seen some changes to the taxation system that will make life easier for smaller companies. We're seeing some acceleration in the spending that they're going to be doing on railway construction, for example. So that there are these small steps just to keep growth bubbling along. And incrementally this can be positive for equity market sentiment.
Will it be sufficient to say that this is a good time to enter the Chinese market?
I think it very much depends on your investment horizon.
Okay.
Our view is that with valuations where they are, and so much negative sentiment priced into the market, if you were to take a long-term view on this, then yeah, you could construct an argument that this is a good buying opportunity for Chinese equities. Obviously, the longer term is much easier to forecast than the short term. So in the near term, there can obviously be a lot of volatility as the market gets used to the idea of less liquidity coming out of the US, for example. That can lead to short-term volatility, and how that affects markets is very, very difficult to call in the short term. So longer term, you can certainly construct the argument that this is a buying opportunity.
Then about Philippines being upgraded to investment grade by both Fitch Ratings and S&Ps in March and May respectively, and is said to be the second fastest growing economy in Asia next to China by S&P. So what is your investment outlook on this dark horse of Asia?
It's a really interesting story, and certainly since the new president came into power there, he's done a lot of good for the economy there. He's making some of the structural reforms, he's investing where he needs to. And so if we look at the Philippines economy, it's certainly heading in the right direction, which is great news. But the market knows this, and Philippine equities have done very, very well over the last 2 years. So actually, if we look at it on a regional basis, we find that once again, coming back to that combination of profitability and valuation, we're finding better opportunities elsewhere in the region. It's harder to find companies in the Philippines that have that combination of profitability and valuation because, in aggregate, the market there is a little bit more expensive than the region.
I see. So, is there any particular market in Asia that you are in favor of?
Once again, our views tend to be driven by where we're finding opportunities on a stock-by-stock basis. Where we are finding those opportunities at the moment at a very broad level is actually among the more cyclical sectors. If we look at defensives, if we look at telcos, if we look at utilities, if we look at healthcare, there have been very favoured stocks over the last couple of years as investors have sought that defensive exposure. So as a result, valuations in these areas at an aggregate basis have been pushed into very demanding levels. at a very simplistic level, the relative valuations of defensives now compared to the broader market are higher than they were during the global financial crisis, which is a bit of an anomaly for us because it's telling you that the market is pricing itself for some sort of disaster. Now, we look at the global economy at the moment and actually incrementally things seem to be getting better. There are still a lot of issues out there, absolutely, but we're not facing the same sort of systemic crisis that we were in 2008. So for us it doesn't make sense that defensives are as expensive as they are. The flip side of that is that there's plenty of opportunities in cyclicals, there's plenty of opportunities in financials, so that's where we're really concentrating our portfolios at the moment.
Since all eyes are on the development of India, the Southern Asia, the Eastern Asia, and also the Southeast Asia, how about your views on the Western Asia?
For Western Asia, it's very early days at the moment. I mean, I don't think a lot of the countries there are even in sort of frontier market status yet. So, once again, there's could very well be opportunities there, but whether or not they're investable at this point in time is another question. So I think if you look at the path of progression for markets within Asia, the next sort of raft of markets where you're seeing more interest and the potential to actually invest in a meaningful way, maybe places like Vietnam, places like Sri Lanka perhaps. They seem to be sort of the next cabs off the rank. They're frontier markets at this point. At some point they'll become emerging markets. I think for a lot of those Western Asian countries, they're still further back along that path.
Thank you, Mr. Adams, for sharing your insights with us here today.
It's my pleasure. Thank you.
Thank you. For more information on unit trust, please log on to www.eunittrust.com.sg or talk to us at any Phillip Securities branches. Thank you.